Even suggest me when to start, and maybe you can start with an intro.
Um, yeah, I guess Vignesh will let us know.
Yeah, I couldn't see how many joined as I'm sharing my screen. So,
Vignesh, let us know when we start.
We'll wait for 5 more minutes. People are still joining.
yeah.
We'll start in
Okay,
5 minutes.
sure.
Yeah, Dinesh, I think we can start now. People start joining. We have around
Okay.
20 people.
So, thank you everyone for taking the time for joining today. I hope you all can share the screen and you can mention in the comments from where you're joining in from, so we know whether you're based in California or which part of the US are you joining in from. So, just to give you a little background about me, I'm Dinesh Challa. I'm one of the founding team members at Rally Tax. And with me, I have Deepa, who's a CPA and a CA from India. And she's also a founding tax team member at Rally Tax. And at Rally Tax, we try to not just file your taxes. Of course, this is a tax filing season, and all of you must be either have already filed your taxes or looking to file your taxes still, because some of us are lazy too. So we would eventually file taxes in the later half of the April. Or someone who has a lot of complexity around their taxes or waiting for a K1 or any partnership documents, then usually people file an extension and then file their taxes in the later half of the September and October of 2026. At Rally, we try to optimize your taxes year round, not just during the filing of your taxes, but also how do you optimize every quarter. And that's where Rally is trying to build a human plus AI approach where there is a CPA human expert who is continuously helping you, and at the same time, you have a technology product experience which is helping you to be more productive and more faster. So we are backed by top experts from elite big four accounting firms and companies like CBiz. We have experts joining in from top accounting firms. And I'm sure most of you must be feeling that you're paying too much on your taxes. We have had stories where people usually, when they're filing their taxes, like a husband and wife working in Credit Karma or Coinbase, and husband working in Apple or in Meta, and usually during the tax filing season, they come to a tax expert to estimate the amount of refund that they're going to get because they're already assuming that they have paid so much in taxes. Suddenly, once the tax expert prepares their tax return, they see that they owe 100K more or 200K more to the IRS or to the state. And we have seen people struggling to figure out ways to pay, how to pay back to the IRS. Is there any advance payment option with the IRS? Is there any installment option with the IRS? Or do they have to take out the money of their savings account? And people really get surprised when they see their tax bill if you are not planning it throughout the year, or your employer, you submitted a wrong W4 or an incorrect W4 because you got married or you purchased a house or your deductions increased or decreased. You didn't fulfill your W4 properly, because of which your employer has withheld lower amount of taxes through the year, and you didn't realize as soon as the tax filing season comes, you are ending up paying a lot of money back to the IRS because of a simple reason that you could have adjusted your W4 withholdings. And the rules are very complex in the US. Most of us in the open venture community and in INRI and rally community, most of us are immigrants. We don't have a dadaji or dadiji like how in India, where we are told what to do and what not to do. Here, anyways, we are immigrants. First to be an immigrant, or first to be an engineer, or first to be the one who is working in the tech company, trying to manage everything on your own. Of course, taxes and finances comes the last priority, whereas our immigration or job, career, these things are primary. So we end up losing sight on your taxes, and you don't have somebody guiding you throughout the year on what to do and what not to do. So the complex rules make it more complicated to file taxes. And also losing trust, because some of us either file through some random tax company either in India or some tax expert in the US who doesn't give you the appropriate information, and you feel that they're not doing the right job and you end up losing the trust. So these are a bunch of reasons that we've observed why everybody is feeling that they're paying too much money in taxes. And if you are proactively planning your taxes, then you're able to save decent amount of money by optimizing your taxes, by ensuring that you are contributing to different programs like 401k, Roth, solo 401k, HSA, backdoor Roth, mega backdoor Roth. These are all the instruments that you would be able to utilize to optimize your taxes. Contributions to 401k are tax deductible. So whatever amount that you contribute to your 401k, they are tax deferred. So you would not be taxed now, and you would be taxed during post your retirement time. So until then, for example, if you're contributing 10,000 or 20,000 to your 401k account, then the entire 20,000, the tax on the 20,000, depending upon your effective tax rate, be it 20% or 20% or 30%, your tax bill is another 4,000 or 6,000. So just by contributing on every $10,000, you're saving anywhere between $1,000 to $2,000 uh, on your taxes. Same applies to your HSA account. Either you could, if you're a single or you're a joint and you have a high deductible health plan, then you are able to uh, defer tax. You are able to remove the taxes on the HSA contributions. HSA is a triple tax advantaged account, which means that unlike 401k account where you have to pay taxes during your retirement, through a HSA account, you don't need to pay any taxes. It's going to be totally tax free. So the first advantage from a HSA account is whatever contributions that you are making, you're not paying any taxes. And whatever money that grows through the time and during your retirement, when you remove the money, you're not paying any taxes. And the third advantage is through the process, if you incur any medical expense and you have to pay through the HSA account, you can pay it tax free. So let's take an example. A couple living in the Bay Area who has a high deductible health plan, and they can contribute around $8,000. So on $8,000, if their effective tax rate is 20%, then they're directly straightforward saving $1,600. And they're investing that $8,000 today, and in next 20 years that $8,000 might become anywhere 16,000 or 20,000, depending upon the growth and the inflation and the compounding. So whatever growth that happened, this 8,000 when it became 20,000, when they're taking the money post retirement, they don't pay any tax on the $20,000 also. That's the second advantage. And the third advantage is through the process of them becoming older from 30 years age to 60 years age, if they incur any medical emergency or any medical expense, they could use their HSA account to pay the bills. And that's the third advantage. So that's why HSA is called a triple tax advantaged account. In case if you have retirement accounts and you're considering how to optimize your taxes, you can look at HSA as a top priority if you have a high deductible health plan, just because it's a triple tax advantaged. And then you have 401k account where you will defer taxes now, but in future you're still liable to pay taxes. And then you have Roth, you maxed out your 401k, or you think that like later anyways I have to pay taxes, so why don't I just pay it now and avoid taxes in the future? That's when your Roth IRA account comes into play. How Roth works is you contribute the post-tax dollars into your Roth account, and as the account keeps growing, if you take out the money post-retirement, you don't need to pay any tax. For example, you contributed 3,000 or $5,000 today, which is post-tax money, and that 5,000 grows to 10,000, 15,000, whatever X dollar it grows depending upon the investment growth. If you take out the money after your retirement, then you are not paying any tax. So that is Roth 401k and HSA account. And you also have a solo 401k account if you are a business owner. If you are not qualified to contribute to Roth because of your income limits, then you could do a backdoor Roth. If you want to move your money from 401k account to a Roth, then you could do a mega backdoor Roth. So these are a bunch of confusing terms. If you're unable to understand, an expert at Rally could help you. And you could also look at donor advised funds or charity as an option in case you are paying huge amounts of tax bill. And if you are somebody who is using Robinhood brokerage or doing stock activity very actively, then it's very, very important for you to understand how to utilize your tax loss harvesting, what is mark to market election. Especially, I'll just touch on tax loss harvesting. Every year, you can only deduct up to $3,000 of your carry forward losses. So, what does it mean? For example, you did trading last year, you have got a $25,000 loss, and you cannot take out all the $25,000 loss against your active income, which is your W2 income. For example, you're working at Google, you're making $500,000 as a W2 employee, but you also have a brokerage losses of 250K or 25K, X amount. So if you have the 25K of loss, you are able to take only 3K from that loss. Remaining 22K carry forwards to next year. So that's how tax loss carry forward losses work out. But in case if you have a gain of 27,000 the following year, then you would be able to offset the gain with the loss that you incurred the previous year. So that's how tax loss harvesting works. And I would be also covering exchange funds and charitable reminder trusts in the next slides. So exchange funds. If any one of you have any questions until now, whatever we have covered, you can post it in the chat and we can cover question by question once the webinar is presentation is completed. So exchange funds have become very important these days. I'm sure if you're working in big tech, you must be seeing ads on your Instagram or on YouTube telling that all your net worth is tied up in one single stock and you might lose it overnight. So that's why you need to consider exchange funds. So if you're working again with Google and you have one $500,000 of compensation, but all your compensation is not received in the form of direct cash. Either 50-50 or 60-40, there is a split for each company stock admin plan. But usually, let's to keep it simple, let's assume 50% you're receiving as cash and 50% you're receiving as RSUs, which are restricted stock units. So you have been receiving stocks around half of your compensation, and let's assume that you are working in big tech since the past 10 years, or you're planning to work in big tech for the next 10 years. So you're accumulating stock in every company that you're working at, and you might not be selling them. So as soon as like around 2 million worth of stock is in Google, your entire RSUs are in Google, and you haven't sold them yet, and if the Google stock goes down by 10% or 20%, your net worth immediately went down by 10% or 20%. So how do you solve that? Like to avoid, because at Rally, we have seen a lot of customers telling that they couldn't sleep the next day morning when the stock market goes through a bloodbath because the customer works in Apple and he has been in Apple since last 10 years, has majority of stock in Apple, and now as soon as the Apple stock goes down because of some random news, their net worth is also going down. So people have two options here. One is sell and pay taxes on the gains and reinvest those into the market, either whichever investment option that you want to invest in. And the second option that you have is without selling, without paying any tax, you could still diversify your stock. And that's where exchange funds come into picture. So at exchange funds, you're exchanging your Google stock with somebody work. There is a pool created by an exchange fund administrator, and the exchange fund administrator will collect employees of Google, employees of Apple, and they would be exchanging stock with one each other and creating a pool. So in case you want to diversify your Google stock against oil and gas funds, or you want to exchange your Google stock with a real estate fund. So whichever fund that you want to exchange, you would be able to do it without triggering any tax bill. Thus, let's assume that you sold $10 worth of Google stock. If you're living in California at a $500,000 salary, you are paying 50% in taxes, which means that $5 goes to the IRS and the California state. You're just left out with $5, and you again go back to the market and you invest those $5. Whereas using exchange funds, you are able to invest the entire $10 without incurring any tax bill. If you guys have more questions on exchange funds, you could post it in the chat. But this has been picking up more and more recently. And charitable reminder trusts are an upgraded version of exchange funds where in exchange funds you are exchanging with another stock, but in charitable reminder trust you don't need to exchange. You can move all your stocks, either crypto, you were very early into Bitcoin, or uh, any crypto project, or you are an early employee of a Coinbase or Databricks or any big tech player, and you have accumulated more than $500,000 in gains in your stocks. So that's when charitable reminder trusts open up. There are different types of charitable reminder trusts which will help you to define your terms, flexibility, beneficiaries. There are CRUDs like NIMCRUD, different types of CRUDs. But on a high level, we would be just talking how exactly charitable reminder trust works. So again, the same Google employee example, that he has got stocks of around $2 million, out of which $500,000 is the gain, which means whenever his stocks got vested into his account, they got vested at a $1.5 million value. Today, the value of that same stock is $2 million. If he goes to a brokerage and tries selling the stock, then he has to immediately pay tax on that 500K. So instead of paying tax, which would be around 250K, right? So instead of paying that tax, so on a $2 million, he's paying a 250K in taxes. So the remainder amount is available to go and reinvest in the market. Instead, if the same Google employee uses a charitable reminder trust option, creates a trust, and moves the stock to inside a trust and sells the stock, then he wouldn't be paying any taxes immediately. So, like, you are immediately saving the entire tax bill and also reinvesting more money into the market. The only catch with a charitable reminder trust is that you will not be able to take out the entire money in one single year, which means that you don't have access to liquidity, the entire liquidity in the same year. It will be within the trust. You will be able to invest into any asset of your choice. Either you want to invest in real estate or in Roth 401k or in startups or in equity market, you would be able to do that from the trust. But you cannot take the money out bulk in one time. You would be able to take out the money in the form of distributions every year. For example, if the trust term is 10 years or 15 years or 20 years, let's assume it's 20 years. If the trust term is 20 years, then you're taking out the money every year, 10% of the whole trust value as distributions. And you will have to pay taxes on the distributions. But if you look at the overall calculation, the charitable reminder trust option is more beneficial than just going and directly selling. There's another constraint from the IRS using a charitable reminder trust is you have to donate 10% of the remainder of the trust during the end of the trust time to charity of your own choice. So for a $2 million, you will have to give 200K to the charity of your own choice during the end of the trust term. But still, if you do the numbers and do the math, and at Rally, our experts are certified and qualified to connect you with lawyers, trust attorneys who would help you in creating these trusts. So we can chat more in detail on your specific scenario. And the last option which lot of W2 earners these days are using is solar and clean energy tax credits. So solar was started in Inflation Reduction Act. Like the solar tax credits are available from a very long ago, and there's so much money going into solar energy investments, and the tax credits are also there. But with the Inflation Reduction Act in 2022, you are able to transfer your tax credit. For example, if there is a developer in Minnesota or in Texas or in California who is building a solar infrastructure project and has got $1 million tax credit with them, they can exchange their credits with you for an X dollar amount of money. So, how it works? So, as soon as you invest $100,000, you would be able to get $150,000 to $130,000 back in the form of tax credits, bonus depreciation. Um, so we have helped a lot of customers invest into solar energy projects. So our customers usually invested $300,000 and they've got 1.3 to 1.5 in return in the form of tax credits. So solar projects are getting expired in 27 through 2030, depending upon the regulations. So if you are somebody who is an active earner and making a lot of money and you have a huge tax bill and you are not interested in doing long-term options like charitable reminder trust or exchange funds, then solar is a good bet that you could review into. And the easiest option, which a lot of people do, is LLC optimization. In case you are eligible to open an LLC in the US, which is you have a valid immigration or you're a citizen, then you should be thinking about diversifying your sources of income, because a lot of people come to Deepa, who is in this call, and to me or to our expert CPAs asking, hey, how do I optimize my taxes? The high level answer to that is you would never be able to optimize your taxes if your single source of income is just W2. You will have to diversify your sources of income as active income and passive income. And you also need to look at how do I create a business or a value of an enterprise so that you would be able to optimize some of the expenses which you unintentionally spend on your business but you don't account for, like traveling for a business purpose or meeting someone for a business purpose or doing anything that's related to business. You would be able to detect that and offset it against your active income. So LLC optimization, doing it in the right way, some people just don't realize and they put in every family expense also into an LLC optimization. And then we have seen thousands of our customers coming to us mentioning about an IRS audit where their tax expert just blindly asked them to put some fake expenses, and then the IRS received a notice. So if you're optimizing your LLC for your side income, still you need to do it the right way, and an expert CPA at Rally would be able to help you out to do it the right way. And we have come to the final slide of the presentation for today, which is if you're looking to file your taxes, then you'll have to sign up on Rally Tax. And the process is like as soon as you sign up on Rally Tax, you would be able to choose an expert and schedule a call with the expert, upload your documents, ask any questions if you have through the chatbot or through a direct call, and then you will review your draft and e-file your tax return. And we also help you plan your taxes once your filing season is completed. As mentioned throughout the presentation, that Rally is a year-round tax advisory product with expert CPAs on the platform. So we would be helping you post tax filing also to help you plan your taxes, because tax filing is pretty easy. Everybody is doing filing, but planning, you would find very few teammates, CPAs who would be doing planning, and Rally is the destination go-to place to file and plan your taxes. With this, I'll open up for questions. So I could read the questions. Kiran mentioned that is there a way to avoid tax while withdrawing traditional IRA account at 60 years? How to plan for this? Kiran, yes, you will be able to remove if you have your 401k limits are under control. We'll have to review your case specifically. We cannot give you a generic advice whether you will have a tax or not. So I would advise you to go on to rally.tax and set up a call. You can set up a free call, free consultation with 20 tax experts that are on our platform. I'm happy if you guys have any questions to answer. Yeah.
Uh, I have some questions. Can I ask over a phone, or do you want me to put it
Yeah,
in
yeah,
chat?
yeah. You can ask. Yeah.
Hi. So I have some rental income from India, and I also have some income out of my agriculture back in my hometown. So my question is, do we need to declare those incomes while you file tax returns here?
Yes. First of all, as a non-resident, like if you have more than $10,000 in any of your bank accounts or stock brokerages in terms of cash, then you will have to file FBAR. And if you have more than $100,000, then you will have to file FATCA. So FBAR and FATCA are two compliance requirements that IRS expects you to follow. And on the top of it, if you have any mutual funds in India, then you will have to file PFIC forms to declare what was the gains each year and have to file taxes. Answering your question on the farmland, if the income is less than $10,000 and you haven't received a specific tax form from a bank, because usually banks give you an interest form or dividend form, or they usually deduct TDS. So in such scenarios, you will have to report. And it's always good to report everything in the US so that your tax statement, tax transcript is clean.
Okay. Sorry, one last question. So if you have a rental income from India, and if the
You will have
house
to report it.
is, if the house is, let's say, 10 years old, is there a way that we can show depreciation,
Yeah, yeah,
something like
you can
that?
take that. Yeah, yeah.
Okay, awesome. Thanks.
Yeah, just that you cannot offset it against your active income. Let's assume, as you mentioned, depreciation. Let's think that you are depreciating the house and your income is less, so the depreciation is high and there is a loss from that rental transaction. A lot of people, what they do is they just offset it against their active income. So you have $100,000 full-time income and you have a $2,000 loss from your rental. So they just offset it against 100 minus 2000, then they put taxable income as 98K. Instead, but that's false, and IRS doesn't qualify it to be legit. People just do it without knowing and then later paying taxes. So you will just have to report, but you cannot offset it against your active income.
Okay. Yeah, thanks much.
Yeah. So any other questions from anyone before we wrap up?
So maybe if there are no questions, I just need to ask one more questions actually.
Yeah, sure.
So let's say if my foreign bank account had maintained some amount, I mean $10,000 above. I mean, if my foreign bank account wasn't maintained $10,000 anytime in the financial year, then we don't need to declare the annual foreign income, correct? Or does it
Yeah,
matter?
cumulative accounts, like your entire, like it's not one single account. If you have two, three accounts, and if the entire two, three accounts value is less than 10,000, then you don't need to.
So even we don't need to declare the foreign income in that case.
No, foreign income you need to declare. I'm sure in India you must be filing taxes, right? If it is a foreign income, they aren't they deducting TDS?
No, actually, this is, I mean, I'm having a hard time with my tax guy this year because the thing is now India says, hey, I think the India less than 12 lakhs per year is tax free. So, I mean, my income wasn't 12 lakhs per year. So there is nothing to pay in India. But I
But
don't know
in
what to
US, you
do.
will have to report in US. Yeah.
You
Okay.
can take the credit of TDS which you paid in India for the income. TDS might have been deducted from the bank directly.
No, but my income is less than 12 lakhs. Why would there be a TDS actually, right? Because it's a tax free,
Uh,
correct?
that is for tax, like finalizing the tax of India. The 12 lakh limit is for that thing. But TDS is deducted anyway. Like if you get some income directly in the bank, they usually deduct the TDS. So you can take that credit against this rental income here. But
Okay.
rental income you have to show here. There is no
Oh,
choice. Yeah.
okay. Okay. Sure. Thanks.
Yeah, why don't you just go ahead and set up a call, Rugan, and Deepa also, you can choose Deepa as your tax expert and you can basically chat with us.
So how do we connect with her? Is it
You can go on to rally.tax and you can click get started and you could sign up and you will see Deepa as your tax expert. And if you're unable to find her, you can click skip and put it in the note and we'll automatically assign her.
okay? Awesome. Thanks much. It
Yeah,
was
yeah,
helpful.
yeah, yeah. With that, I'll take
I
an
have one
opportunity. Go
question.
ahead.
Sorry.
Go
Hey,
ahead.
this is Vinay. I have a question on the pricing slabs for the rally tax. So, I have some K1s from some of the ETNs that I have. So, would that make me choose the last pro option, or can I still?
No, we're pretty flexible. It's just to give you a direction. Our pricing is kind of like cheaper than H&R Block and Jackson Hewitt, and maybe slightly higher than somebody who's helping you from India because we are based in the US. But that's just to give you a direction. But generally, based on K1s, also, if your return is simple, it would be far lesser than what we are showing there.
Oh, got it. And how would you compare it with the TurboTax assisted filing?
TurboTax assisted filing, you're just randomly connecting with somebody from Philippines who doesn't have a context about you, and next year you wouldn't find the same expert also, right? But at Rally, you're working with the same expert throughout the year, and you have the product experience of TurboTax, and you also have somebody who understands you. Like, would the TurboTax expert understand FPAR, FATCA, or all the rich context-rich information about India and how things happen versus yeah. So that's where Rally excels.
Got it. Okay. Thank you.
So can I claim tax benefit in US for the home EMI I pay in India? Deepa, you wanna answer this?
Yes,
So
for EMI.
yeah,
No, for EMI you
mortgage
cannot take.
interest, right?
No, you cannot take this. Mortgage interest is not allowed for US tax benefit.
Any more questions?
Maybe one question regarding tax withholding. So only the husband works and the wife is homemaker. So in that case, it should be marriage filing jointly, or the single breadwinner comes. There is some like marrying, filing separately, jointly, and there's one more option. So should we go with the joint option? And can we also fill the W-4 form for decreasing the tax withholding? And on that context, when I tried the estimator, it shows some value. Just say, for example, 10,000. It means 10,000 will be reduced from the tax withholding annually, or how does it actually work?
You asked multiple questions, but let's go with your first question, filing status. So if you are filing single, then you have something called standard deduction. So an X amount of dollar you would get, or you can get itemization if your withholdings are itemized, if you have more itemization, right? So ideally married filing joint is better if your spouse doesn't have any income and you have income, then your tax slab would go down. You can go online and check tax slab rates for single and married filing joint and married filing separate. Ideally, you would find the most beneficial player is married filing joint. So it's always standard generically that married filing joint is beneficial, but sometimes it might depend on case by case basis. So we can review and do a simulation on which filing status is helping you. And adjusting your W4, you should always adjust your W4 depending upon your goals. So if ideally for all of us who are starting early, we want more pay, uh, more what do you call, we want more cash every month in our paycheck. We don't want more money as tax withholding. Instead, we want more money coming to our bank account. So in that scenario, you could go and adjust your W4 that you would receive more money in your paycheck. How would you adjust your W4? You, if your filing status is single, you will immediately change it to joint so that your employer or the payroll provider of your employer knows that, oh, this guy's tax slab would be low, so I'll deduct low taxes every month, so he's gonna get higher cash every month. So it's very, very important to adjust your W4 in a way that is set up according to your goals. If your goal is, hey, I want more money end of the year when I'm filing my return as a savings, that also some people do. In that scenario, you might want to adjust your W4 in a way that more taxes are withheld every month, that end of the year you're paying, getting money back from the IRS. So you adjust your W4 depending upon the goals.
Okay, thank you so much. But then,
Yeah.
will the HR help with how much we can reduce it, or like?
Your tax expert will help you. Your HR usually will just take whatever W4 you submit. And
Okay,
like if you mention your HR that, hey, I want to change my W4 withholdings because there are life changes that happened in my life, which is either you got married or either you bought a house or either you have a kid or you have more medical deductions that year, depending upon different life situations, W4 keeps changing every year. And
hmm
you should like basically consult your tax expert to change, adjust your W4 withholdings, and accordingly your paycheck will also reflect. HR is just like
okay,
the copy pasting whatever you give them.
okay. But the value that we give in the step three is uh, we give a value manually, right? For example, 10,000. So 10,000 means the overall tax will be that 10,000 divided by 24, which is bi-weekly. So that much amount will be credited to the payslip bi-weekly. So that's what the 10,000 means, or is
It's
it
not
something
just
different?
one value that you're referring to, it's a total W4. If you see your W4, it asks you about your assets, it asks you about your passive income. So it's a constructive document. You just can't go by a single number on one single line item.
Okay.
You have to thoroughly go through your W4 and put down everything. Yeah.
Okay. Yeah. Actually, assume that there is no asset. So I tried the estimator that is in the IRS platform, and finally it gave me the value of 10,000. So when
But we
when I
don't know
put the
what you put
10,000,
and everything, right? So
okay,
it's,
okay, mhm.
yeah.
All
Why don't
right.
you set up
Yeah,
a call so we can do one-on-one case because it's very
yeah, sure,
difficult
sure.
to decipher what exactly is your situation.
Okay.
Yeah, and somebody asked how to set up a call.
Thank you.
I think
Thanks for
replied.
the
Yeah,
clarification.
yeah, sure, anytime. Any more questions? How many of you have filed your taxes and how many of you are yet to file your taxes? So yes, if it is a post-tax money, then no. If it is a pre-tax money, then we'll have to chat. So you're good. And I also wanted to know, I have an NRE NRO bank account. So check your NRE NRO bank account. If there is any interest dividends that you're receiving, then you are required to follow both India compliance and US compliance. If you have more than $10,000 or $100,000 in those bank accounts, you still have to follow both India US compliance. But for your 2,500 transfer, you're safe. Kevin, I filed. Murugan yet to file. So yeah, consider rally and not just you filed already. If you want to plan also, we are happy to we generate a free tax plan on our website. So you can just go and upload your 1040 or just give some information about you, and we generate a free tax plan, and that might pique your curiosity to work with us. That said, I'm not sure Open Atlas admin, who's the admin?
Yeah, Dinesh, Vignesh.
Hey. So yeah, you want to wrap it up? I think.
Yeah, if everyone is sorted out, we can wrap it up.
Yeah, I think so.
All right, guys. Thank you for attending the webinar. We have the recording for the webinar. We will send you an email campaign with an rally tax site link as well as the regular webinar recordings. So thank you for attending. Thank you, Dinesh.
Thank you everyone for taking the time on a Saturday afternoon, wherever you are. Thank you so much. And thank you, Deepa, for patiently helping us out during the peak tax season deadline. Thank you.
Thank you. Thank you. Bye.